Hi, my name is Khleif, and I'm the host of the Lifetime Cash Flow Through Real Estate Investing podcast. And every week I interview multifamily rock stars, and we talk about how they've built incredible wealth for themselves and their families through multifamily properties. So hit the like and subscribe buttons to get notified every Monday when a new episode comes out. Let's get to it.
Welcome to another edition of How to Build Lifetime Cash Flow Through Real Estate Investing. I'm Khleif, and I'm thrilled you're here. And I know you're going to enjoy the gentleman we're interviewing today. In fact, his name is Blake Janover with Janover Ventures. And Blake is an expert in the multifamily finance game and really capital markets, which is what they call it. And so, you know, he's a member of the Forbes Real Estate Council like myself. He's been in the business for 15 years, very knowledgeable guy. In fact, knowledgeable enough that I had him speak to my Warriors, my mentorship group, because I was so impressed with him. And we're going to dig into a lot of fun stuff today. Welcome to the show, brother.
Man, thank you for having me. I'm shy when you're so generous in an introduction. I hope I can live up to it.
You already have, my friend. So let's dig into who you are and maybe just real quick how you got into the business. And then we've got a lot of fun stuff to talk about that I know is going to add a ton of value today. So guys, you definitely want to stick with this episode today. All right. Let's do it.
I'll follow your lead. So keeping it really brief, I've got about 15 plus years in real estate capital markets experience. It was my first real career, and I've kind of stuck with it ever since. I survived the pretty banged up, although I know you've been there too, but I survived the 2008 tsunami and came out the other end a little wiser and with a tad bit more humility. My background involves billions of dollars of multifamily and commercial real estate finance transactions. I'm also a GP in deals and own units. So I've kind of been all over the multifamily spectrum. And right now our business is focused on, or what I'm doing, my day-to-day life is focused on bringing technology and removing frictions in this small multifamily finance space between $1 and $10 million primarily.
Mm-hmm. Yeah, guys, that is the small multifamily space, just to know, between 1 and 10 million. So, you know, I know you also specialize in really first-time borrowers, which is why I really wanted you guys to listen today. And so, you know, I know you know, which is unusual. A lot of the brokers that I deal with, you know, they get frustrated because there's so many questions and, you know, and things that you know, with a first-time borrower, you know, when you're doing your first deal, you know, that you're a newbie and you really just don't know what you're doing. And so the fact that you do that is a big deal. And, you know, so let's talk about maybe some suggestions you might make if someone has a deal and they're going to come to you and it's their first, or maybe, probably their first. You know, what suggestions would you make to them?
Well, and this is genuine. So my first suggestion is, if it's your first deal, you should be on Rod's boot camp. You should be figuring out how to get in on that.
Oh, thank you. You know, I appreciate that. And I'm probably going to have you speak at the next one, Blake, as well, to really, you know, drill down on the different, you know, the different financing options that are out there. But that said, guys, if you are interested, go to multifamilyvirtualbootcamp.com or text multifamily to 41411. You guys know I do these 2-day boot camps. I don't sell anything at them. And Christ, if you get in early enough, you can get in for as little as $97 or $147 respectively. So it's truly a no-brainer. But thank you for that plug, my friend.
Well, it's deserved. And hopefully I don't botch up this podcast and you have me on the next boot camp. So the pressure's on. Listen, as far as suggestions are concerned, if I can make a stop before I go to suggestions, can I just briefly let people know kind of what their options are and what's really
Yeah. That's even better. Yeah. Let's do that. Thank you.
Yeah, I just want to kind of preface the suggestion part. So I think there's some misinformation out there, and that's that all Fannie Mae lenders make Fannie Mae loans, all Freddie Mac lenders make all Freddie Mac loans. And the reality is that every lender has their own prerogatives and their own credit boxes. So they don't necessarily have to do everything that Fannie Mae allows. There's Freddie Mac programs that some Freddie Mac lenders don't have. There's Fannie Mae programs that some Fannie Mae lenders don't do. And I think a really good example is that you can be a first-time multifamily buyer, a first-time agency borrower, and still get a Fannie Mae multifamily loan.
By the way, agency means Fannie Mae and Freddie Mac, guys, just if you don't know what that means. Okay, keep going.
Sorry about that. So really, really high level. There's a few active buckets right now. There's Fannie Mae multifamily. This is really good for first-time borrowers, secondary and tertiary markets, small markets. This is really good if you want to get a 30-year fully amortizing multifamily loan, and it starts at $1 million and up. But remember, there are 30-year fixed loans for apartment buildings. It's another thing that not everybody really knows about. They're non-recourse, which means there's no personal guarantee. If something goes wrong and you've behaved well, meaning that you haven't triggered any bad boy carve-outs, these are guarantees you make not to do things like tax evasion or something meaningfully illegal. But if something goes wrong, you lose the property, you give back the property, you give back the company, but nobody comes after you personally.
Right. So as far as those bad boy carve outs, that's what they call them, guys. It's kind of sexist, I guess, because they're bad. It's for bad girls too. But anyway, again, you can't commit fraud. You got to keep your taxes paid up. It's stuff like that. But if you don't do any of that silly stuff, and you got to pay attention, as you're managing the asset as well, that you don't go counter to the agreement. In fact, because like we've got an asset right now that we're changing the GP structure on, and we had to get Fannie's approval before we did that. Otherwise, we could trigger recourse. So you just involve an attorney to make sure that you're not doing anything improper that could trigger the bad boy carve outs. Otherwise, again, if they foreclose, all they're going to take is the property. That's it. There's no hurt to you at all. I mean, it will hurt that you won't be able to get more Fannie debt after that, but they can't come after your personal assets. All right. So please continue, my friend.
By the way, with a good story, you can get Fannie debt after that. We're doing a Fannie deal now for someone that defaulted in the past.
Oh, no kidding. Okay, well, there you go. There you go. Okay.
So we've got Fannie. We've got Freddie. Freddie has a great product too. It's really good in big markets. Think like the New Yorks and LAs and the Miamis. A very competitively priced product with more flexible prepayment penalties, which we'll talk about in just a moment. There was CMBS. It was big. Now it's kind of not there.
CMBS, guys, sorry to interrupt, is commercial mortgage-backed securities. This is what caused the 2008 crash where, these loans were sliced and diced and sold on Wall Street. Nobody really knew who owned them. And that market still exists and has existed past that in the commercial multifamily space, but it literally has dried up in the because of COVID. Is it coming back at all, or is it still pretty gone?
It is. It's coming back slowly. It's really tight. It's conservative, like most lenders are right now. So lower leverage, more reserves, the same story. But it's slowly coming back. Highly selective, right? For agency, Fannie, Freddie, fallout, and things like that. Banks are really active right now, but there's execution challenges, right? Because a bank, I always hear the story, right? I got a term sheet from my bank, and I say, well, a term sheet is worth just about what it's written on. And people are getting retraded, and banks are changing the deal later or pulling the deal. So the only way to get real certainty of execution with a bank is if you're coming with deposits or you have deposits. If you've got deposits, you've got a trump card.
You want to build relationships with them, and banks are relationship driven. And of course, the best way to start a relationship is to open an account. Okay. Even if you don't throw like Blake said, if you've got a deposit relationship, you have a much better shot. The term sheets that he was talking about are always negotiable. And like he said, they retrade them, meaning you get to closing and they change their mind about something. So, it's until it's locked, you really don't, like he said, it's not worth the paper it's written on, but you want to build relationships with bankers. And here's why. I've got students that have been offered 100% financing on multifamily properties because of the relationship they had with a bank. I remember when I first started interviewing like 3 years ago, I interviewed a kid that got $1 million deal done with $5,000 down with bank financing because the banker allowed the seller to carry a second. Now, again, that's relationship driven. Now those are anomalies. I wouldn't say that happens all the time, but those relationships are important. Number one. Number two, is, if you've got some relationships with banks and things do go south and they start taking some properties back, I can tell you, if you listen to my podcast, you'll hear some of these guys that, started in 9, 10, and 11, they got bank financed for bank REO property. So that opportunity exists as well. But let me say this, Blake, what someone like Blake does is he gets you lined out with the correct financing for your deal, be it agency debt, be it maybe bridge debt even. I'm assuming you can coordinate that as well. And then also, of course, bank financing for, he's got relationships with banks. And to give you a plug, Blake, one of the advantages of having someone like Blake and his company as a middleman's a horrible expression, but that's really kind of what it is. You're representing, he's representing you when you are communicating with the bank, when you're communicating with the agency lenders, so that you present yourself in the right way. So that, if you decide you're going to give them some information, it's the information that's going to help you, and he can help position it so that you have a much better chance of getting approved. And so that's why using a broker. Would you call yourself a broker, Blake? Is that the correct term?
Advisor, an intermediary.
Advisor. Okay. All right. There we go. Intermediary.
Broker's
That's
okay.
Better. That's better than middleman. Okay. Anyway, but that's why we highly recommend that, especially if you're newer in this business. So
let me just comment on that for a second. Just to comment on that one piece. It's important, even if you're sophisticated and you've done a lot of deals, right? And we have borrowers that have portfolios worth hundreds of millions of dollars, and they still come through us. And one of the reasons is because it's good to have a filter, right? You send us a document and we say, whoa, what's going on there? Walk us through that. How does that property management fee include staff, payroll? What's included in there? What is this line item? What's that line item? How does it work? And you don't want to give a mess to a lender because a lender will immediately get turned off and you'll have to go find another lender. The other reason is because lenders have misaligned incentives. So if I'm a lender, let's say I'm an agency lender. I do Fannie Mae and Freddie Mac, and I have a line of Fannie small and Freddie small. And one of these products. Okay,
hold on. Sorry.
Yes.
What he's talking about is small balance loans, guys. When he says Fannie small and Freddie small, he's talking about their small balance loan programs. And what are the numbers on that?
They're $1 million and up.
$1 million and up, but a 210, is that 210 there, or is that less than 10 on the small balance?
From a rate perspective?
Well, just from a description perspective, when you're talking about their small balance loan programs, at what point is it no longer in the small balance loan program?
Oh, okay. So there's exceptions. So it's generally 1 to 7 million, but you can get exceptions above 7.
Yeah, that's what I was looking for. Okay. So I'm sorry. Hopefully I didn't completely throw your train of thought on. I just want to let people know if there's a term they haven't heard before. That's all.
No, it's important. So I was talking about misaligned incentives. So okay. I'm an agency lender. I make Fannie Mae, Freddie Mac, and FHA multifamily loans, which we could talk about after. And I've got a Fannie small balance, Fannie Mae small balance, and a Freddie small product, right? And the Freddie small product is better for you, but I close a lot with Fannie, and it's easier for me, and it pays me more. You're getting a Fannie loan. That's it. And if you don't have somebody in the middle, the right person in the middle, right? The wrong person in the middle is just going to align with the lender.
What you just described was the lender taking that position. If you went directly to the lender, they would push a product on you that's better for them, not necessarily better for you. Right. But that's possible. But that's where you come in to help delineate the best product. And I like the filter. I like that term much better. I've got to remember that, because that's really the bottom line is you're able to filter out, the things that the lender doesn't need, things that'll confuse or irritate the lender, and help facilitate that back and forth, because you know what they want to see, and very often an operator doesn't. So okay, so please continue with that thought if there was more on that.
So there's actually somewhere else I can go from it. I just don't know if we should go too far off path, but I have a couple examples of deals like that where we were kind of in the middle and it made sense.
Now go ahead, explain. No, I'd love to hear myself. So please go ahead.
So I've got a few deals we did recently. One of them was with a first-time multifamily borrower, not local to the property, so far away from the property in another state. And in this case, we had to assist him in finding another qualified sponsor. So he actually sent us a list of everybody that he knew that he thought might be a possible co-GP, a member of the general partnership with him to sign the debt. And we went through and we vetted every single one of them and picked the person for him to do his deal.
Wow, that's quite a service. Okay, fantastic.
and by the way, on agency, we're almost never charging a fee to borrowers. We're doing rev share with the lender. So side note.
Okay, fantastic. So second example.
So we just closed a deal. The borrower had only 6 months of multifamily experience, never did an agency deal, wasn't local to the property, and was also renting the units by the bed to start. So what we had to do was we helped coordinate with him to find an acceptable property manager to pivot from bed to unit leases, got him qualified, and close that loan for him.
Fantastic.
That was a hairy one also. And we've got another one with a property that's stabilized, but there's a bunch of down units, but the units don't have to count against occupancy because they're down and they're getting renovated, and we got a waiver for that. So there's no really fixed box. There's a good story and a good asset and a good borrower. There's a creative way to get it done.
Explain what Fannie and Freddie look for as far as it relates to stabilization.
90 days of 90% occupancy is their number. Depending on the deal.
Remember this, guys, 90 for 90. Memorize that. Okay.
90 for 90. And then, they're looking at things like debt service coverage ratio, which is the relationship of your mortgage payment to the property income. So
explain that with a little more detail, if you wouldn't mind.
Sure. So if your property is earning $120,000 a year in NOI and your mortgage payments are $100,000 a year, that's a 1.2 debt service coverage ratio. Your property's income is 1.2 times your annual debt service.
Yep. And the minimum, the absolute minimum that most banks and agency lenders want to see is 1.25. And so, because guys, what they're looking for is the property's ability to service the debt, much less your ability to service it. It's really about the property's ability. And that's what that debt service coverage ratio is. Now, that debt service can be, that ratio can be higher in certain circumstances as well, correct?
Yeah, and if the debt service coverage ratio is higher, you're getting a lower rate, better terms, some interest only, a more flexible prepayment penalty, perhaps. So it's all kind of intertwined. If you pull one place, you're getting some push somewhere else. So yeah, and by the way, you mentioned something before, and I took note of it with my number 2 pencil because I use a number 2 pencil. We were talking about bad boy carve-outs, and it's generally if you do something that's would constitute a bad boy or bad girl move. However, if you're an experienced borrower and you're doing complex bank deals and things like that, and you're getting a non-recourse loan, something that non-recourse lenders have done over the last few years is slip in provisions that would essentially trigger recourse that have nothing to do with bad boy carve-outs. For example, something that lenders will slip in sometimes is you have to send us your annual financial statement within 90 days of the end of the year. And if you don't do that, you are technically in default. So read the carve-outs carefully, because it's not just broad behave yourself. There are things slipped in there that are meant to deceive.
Well, I'm going to tell you better than that. Make sure you've got an attorney that really knows what they're doing, reviewing those as well, because there's a high level of detail in that review. And is that negotiable? Just a question I don't even know the answer to. If you get a document like that and they've slipped that crap in, is that negotiable? Is that something an attorney can say, we don't want that in there, or is that not going to be happening?
Everything's negotiable. Listen, If you're doing a $1 million Fannie Mae multifamily refinance, it's not negotiable.
Right.
If you're doing a $10 million CMBS loan, it's all on the table.
Okay.
Everything's negotiable. And by the way, speaking to your attorney comment, right? The most important thing, this is the first question you asked me that I totally didn't answer, but you said, what's your advice to somebody that's a first-time borrower? And I said, join Rod's boot camp, because it really is the right thing to do. And I mean that. And I get zero compensation for saying that.
Thank you.
And the other thing is to build the right team. That means you don't get a residential attorney or a traffic ticket attorney to look at commercial mortgage documents. And you don't get a single family property manager or a commercial property manager to manage a multifamily property. These things are really, really unbelievably important. And one of the wonderful things about using a Fannie Mae or Freddie Mac lender, not that they're the only game in town, but because they've done tens of billions, hundreds of billions of dollars of loans, of multifamily loans, they know what to look for. They know who to hire to look at the property. They know what appraiser to use, what PCA inspector to use, what environmental study to use. So they're doing due diligence for you, and it's pretty much free.
Yeah. And explain what PCA is, please.
That's a project capital needs assessment, or PCNA. It's what an agency lender would use to determine what kind of work is needed in the property immediately and over a period of years. So they may do an assessment and say, okay, there's a life safety issue in the parking lot. There's a hole in the parking lot that somebody can fall into, and you have to fix that before closing. And we think the economic life of your roof is 7 years. And we're going to start reserving money up front so that when the 7 years come, you have money in reserve to compensate for replacing the roof.
So guys, when they do that, when they order that PCA study and they get it back, they're going to tell you what your reserves are going to be, that they're going to require to hold for that asset for things like roof and HVAC and parking lots and whatever else can break down. And I will say that is also negotiable, but that's just something that's very often forgotten. Now it's your money. When you fix that thing, you're going to get it back, but you've got to factor that into your returns. So first time borrower, yes, of course, come to my boot camp. Duh. but yeah, get it. You put a team together, and you put a team that knows what the heck they're doing. That's in the business, in the commercial multifamily business, not residential multifamily business, and an attorney that knows commercial contracts, and a property management company that manages assets like the one you're buying. Very, very
great
important.
Intermediary.
Yeah, and a great lending intermediary or advisor or filter like Blake.
A middleman.
Right. So anything else that you could say to a first-time borrower?
Yeah. So this is important. Let me choose the right words. Returns are risk adjusted. When you see an 18 cap on LoopNet and you think, wow, I've hit the jackpot. Something my mother would say to me is, why are you so lucky? And generally speaking, I'm not so lucky. So when you see an 18 cap, some things you may want to consider are, is my life in danger when I go to collect the rent? Is the property even legally zoned? I'm not saying that great deals don't exist, but usually if you find a great deal, it's through a relationship, it's off market, it's not in a giant public marketplace that everybody can see and everybody in the world has access to. So be considerate. And like the something I just want to add to that, right, is generally speaking, and this isn't a fixed rule, but it's a rule of thumb. If I'm getting a low cap rate, that means I am in a dense, economically active market, and my income is low, but my chance for appreciation may be bigger, non-cap rate related appreciation. Whereas if you're buying something with a high cap rate, you're taking your gains now in many cases in current cash flow, but your appreciation may be less substantial.
If at all, and the exit strategy may be non-existent because
Right.
you're really just buying cash flow. And if you've got a high
Right.
cap rate, chances are you're in the hood. Okay,
Yes.
so let's just call it what it is, and that's the truth of it. And I got to tell you, I talk about this in great detail at my boot camps where I bought properties in D areas, D properties, and I regret every single one of them. And some of them on their face looked like screaming deals, but I regret every single one of them. So, okay.
Gentrification happens in these small markets, but it's hitting a roulette table in the casino unless you have insider information.
Listen, let me say this. Yes, areas gentrify as well. I mean, I could tell some pretty amazing stories about gentrification. I'll give you one real quick. I bought a fourplex for what was it? $80,000 for all 4 units, two-story, 3-bedroom, 2-bath units each, garage behind them. I paid $80,000 for the whole building. Each one of those units now is worth about, I don't know, somewhere between $700,000 to $1 million, in Denver where it gentrifies. So that is possible, but you're going to deal with, we found a dead body in there at one time. Okay. So, I'm just telling you that you got to deal with that exact property actually. So, yeah,
that's an agency issue. They're going to look to see if there was crime on or around the property in the last year. If there's dead bodies and garbage cans, you're not getting an agency loan.
Right.
I hope you have a good bank relationship for that one.
Anything else for a first time, or can we go ahead and move on to prepayment or yield maintenance?
Let's move on.
Okay, so let's talk about prepayment. In the single family space, that's what it's called. In the multifamily, larger multifamily, it's called yield maintenance. Can you speak to that a little bit and how you can mitigate it?
Sure. So yield maintenance is a type of prepayment penalty, or if you want to sound fancy when you're talking about it, you can call it call protection. That's what people in the know might call it. But there's yield maintenance. Which is one. We don't want to get into the mechanics of it, but it's generally going to be more expensive. Defeasance, which we really don't want to talk about, and that may be more expensive as well. And then there's step down prepayment penalties. So a step down prepayment penalty is kind of like how it sounds. If it's a 10-year loan, it may start at 10%, at 10% of the loan amount for the first year if you pay it off, and then the next year 9%, next year 8%, 7%, all the way down to 1%. Now, there's different kinds of step-down prepayment penalties. So there may be a softer 10-year step-down prepayment penalty, which may be like 555, 444, 333, so on and so forth. Freddie Mac has Freddie Mac Small Balance has a couple products where they have really, really light prepayment penalties. And I'm not going to quote it right, but I think we've got a 5-year where it's like 321. And then 0-0. And you have to pay for it, right? Like anything else, you want to get rid of the yield maintenance. You want to have a step down prepayment penalty that you can that you can really predict better. You're going to pay a little bit in the rate, 10, 20, 30, 40 basis points, depending on the type of loan and everything else. Prepayment penalties don't generally go over 10 years. So if you have a 30-year loan, you're getting a 10-year prepayment penalty and everything's going to be okay after the 10
After the 10 years. Yeah. By the way, basis points, guys, they're also called BIPs, and there's 100 basis points for every 1% interest. Okay. And that's how you basically carve up a percent interest. You get, 50 basis points. It's 0.5%, just to clear that up for the brand newbies. Okay.
Yeah, when dummies like me want to sound smart, instead of saying 1%, I'll say 100 bips or 100 basis points.
Right.
Sorry for that.
It's all right. It's all right. So let's talk about anything else COVID related. Well, certainly let's talk about the new reserves and anything else that comes to mind as it relates to COVID.
Sure. So the COVID reserves, Fannie and Freddie used to have a top of around 80% LTV, and it still is, except for the fact that you're ponying up 6 to 18 months reserves if you're borrowing more than 55% LTV. So
this is new, guys. Okay, so you used to be able to get 80%. Loan to value, and no reserves like he's speaking about here, other than, of course, reserves for CapEx, but future CapEx, but PCA, but this is new because they see the volatility in the market, so they're requesting 6 to 18 months of principal and interest of what your payment would be in a reserve, just in case. Now, when do you get it back?
So everybody's got different rules around it, but the rule of thumb is that if you have continued economic occupancy economic occupancy,
Right.
not physical occupancy.
All right, hold on. Let's stop there for a second. Okay, so guys, there's a difference between physical occupancy and economic occupancy. Obviously, physical occupancy is bodies in units. Well, body's the wrong word in light of our recent conversation. People in units. But economic is the ones that are actually paying, which is really relevant in this COVID world we're in with eviction moratoriums and the CDC BS and all that stuff going on. So back to your comment about is it continued economic occupancy? Does it need to improve, or does it just at least need to be stable? Stable.
Yes, stable. Above 90%, or I don't know what the most recent number is, but it's about that. And by the way, there is nothing worse than a building right now with 100% physical occupancy and no economic occupancy. That means you got a bunch of people in the building that you can't get out and that aren't paying you.
That's happening in New York a lot, in some of the other blue states that are really strict on this. So guys, so after what period of time though? I don't think I'll let you answer.
12 months.
12 months. So after a year of stable economic occupancy or improved, you'll get that reserve back, but you got to factor it in up front,
Don't quote me on that. It might be 18. My brain is
12 to 18 months, 12 to 18 months on that, on getting that 6 to 18 months of reserve back. Okay. You'll get that PI back, and you can factor that in when you're doing your pro formas, but just recognize that's going to go into the bank initially. Yep. So anything else COVID related that you've seen an impact on other than CMBS market just falling away for a while?
So I'm going to say something that people are going to think is crazy. And I'm going to preface it with COVID has had a terrible impact on some properties. Think multifamily in Manhattan. Think student housing, just decimated, right?
Retail, office. I've got friends that own a lot of retail that they're telling me is 70% of their tenants need help. So it's a big deal. And a lot of retailers have gone out of business. Anyway, please continue.
So the thing that I want to point out is that we have to disaggregate these things, like break them into smaller pieces. So retail is hammered. Right. Single tenant, triple net credit tenant retail, doing fine.
Right. That's by the way, guys, that's the Walgreens and the CVS you see on the corners where there's one tenant in a building. Yep. and they don't, the Walgreens, Burger Kings. Yeah. They don't own the building. They're called single tenant retail. And yes, they are doing fine. Please continue. I just want to expand on stuff that you threw out there. Okay.
Yeah. I'm sorry. So other examples, office hammered.
Right.
Long-term leases in office buildings in Manhattan where there's great tenants on 20-year leases, doing fine. Those buildings are going up in value because those tenants are paying their rent whether they're coming to work or not. Right. And that's important to share. So what I want to point out is that in multifamily, if you have an apartment building that's been resilient, that's continued to collect over 90%, of collections, right? That's performed well. That's been resilient. Well, what's going on right now is that there is this giant spread between treasuries, like the 10-year treasury, and cap rates. You see, the 10-year treasury has gone down really low, and cap rates have either stayed the same or maybe climbed a little higher. And traditionally, there's a fixed number between what treasury rates are and what cap rates are, and it's spread really wide right now. And I think, for whatever the heck it's worth, is that the properties that have performed well should experience, it's a crazy thing to say, and it's not something to base a business model off of, but should experience cap rate compression as the spread reduces and cap rates compress and come down closer to where treasury yields are. Because you're going to be proven to have an investment that is resilient and safe and yields more than treasuries, and it's survived and performed well during a pandemic. So I just want to.
By the way, cap rate compression means values go up, guys. That's cap rates counterintuitive. Cap rates go down, values go up. Cap rates go up, values go down. Okay.
That's right.
Anything else on the COVID business or?
No, I'm tapped. You know everything I know now. This is
well.
The glass is empty.
Listen, brother, I really appreciate you coming on the show, and I'm looking forward to really having you speak at my boot camp and really drilling down on just the nitty gritty on each of these different types of finance and so on and so forth. Again, it's what's your website?
Janover.ventures. It's not .com or .net. Actually, can I just add? I think that a more interesting site for your listeners and viewers would be multifamily.loans. So that's multifamily.loans, not multifamily.loans.com.
Okay. And there's some resources there, correct? I think you mentioned that maybe previously. Yes, so things that you can. Okay. Well, listen, thanks for being on the show, brother. I really appreciate you being here, and I'm sure we'll talk very, very soon.
Thank you so much for having me, Rod. I really enjoyed this.
Good. Thank you. Likewise.
Rod, I know a lot of our listeners are wanting to take their multifamily investing business to the next level. Now, I know you've been hard at work helping our Warrior students do just that using our ACT methodology, which is awareness, close, and transform. Can you explain to the listeners how they can get our help?
You bet. Guys, we've been going nonstop for 3 years, building an amazing community of like-minded people. And our coaching students, which we call our warriors, have had extraordinary results. They've purchased thousands and thousands of units. And last year, we did over 1,000 units with our students. And we're looking to grow this group and take it to the next level. We're looking for people who want to follow a proven framework that's really step by step, and then leverage our systems and network to raise equity, to find and close deals, and to build partnerships nationwide. Now, our warrior community is finding success in any market cycle. So if you're interested in finding out more about how you can become more of our incredible network and take advantage of the incredible opportunities that are coming very soon, apply to work with us at mentorwithrod.com or text CRUSH to 41411. That's mentorwithrod.com or text CRUSH to 41411.